Stay informed with Subscribe now for news that reveal the truth behind global events. Exposing the challenges in the luxury car industry. For decades, Porsche has stood as a symbol of German engineering, precision, performance, and timeless design. The brand has become synonymous with excellence, capturing the hearts of car enthusiasts and collectors around the world. From the bustling streets of major cities to the serene, winding roads of the countryside, the presence of a Porsche is unmistakable. The iconic 911 silhouette is instantly recognizable, a testament to a legacy built on racetrack victories and relentless innovation. Its design has evolved over the years, yet it retains the classic lines that make it a timeless piece of automotive art. Each curve and contour is a nod to its storied past and a promise of thrilling drives ahead. Every Porsche carries the Made in Germany mark, a badge of quality and craftsmanship that fuels its global allure. This mark is more than just a label. It's a guarantee of the meticulous attention to detail and the high standards that go into every vehicle. It's a promise of reliability and performance that has been upheld for generations. The factories in Zuffenhausen and Leipzig are more than plants. They're sanctuaries where skilled hands and advanced robotics create high-performance machines. These facilities are a blend of tradition and innovation, where the latest technology meets time-honored techniques. It's here that the soul of each Porsche is crafted, ensuring that every car that leaves the factory is worthy of the Porsche name. Porsche's business model is built on exclusivity, not mass production, catering to a discerning clientele willing to pay for superior performance. This approach has cultivated a loyal customer base that values the unique blend of luxury and speed. Each Porsche is not just a car, but a statement of style and sophistication. This strategy has made Porsche one of the world's most profitable car companies per vehicle. The brand's focus on quality over quantity has paid off, allowing it to maintain a strong financial position even in challenging economic times. Porsche's success is a testament to the power of a well-executed vision. But as the world shifts toward electrification, Porsche responded with the Taycan, proving its performance DNA could thrive in the electric era. The Taycan is not just an electric car, it's a Porsche through and through, with the same commitment to speed, handling, and driving pleasure. It's a bold step into the future, without forgetting the brand's storied past. The Taycan's success signaled Porsche's readiness for a battery-powered future, with bold investments in new technology. The company is not just adapting to change, it's leading the charge, setting new standards for what electric vehicles can achieve. Porsche's commitment to innovation ensures that it will remain at the forefront of the automotive industry. Yet, just as Porsche seemed poised for the next chapter, global economic and political forces threatened to upend its plans. The brand faced challenges that tested its resilience and adaptability. In a rapidly changing world, Porsche had to navigate uncertainties while staying true to its core values. The brand's future would soon be tested like never before. As it faced these trials, Porsche's commitment to excellence and innovation would be its guiding light, ensuring that it could overcome obstacles and continue to thrive in an ever-evolving landscape. In 2025, the US government made a bold move, imposing sweeping tariffs on imported vehicles from around the world. This was more than just a policy change. It was a seismic shift in the global auto industry, sending ripples through every corner of the market. The goal was clear: force foreign automakers to build their cars on American soil, creating jobs and boosting domestic manufacturing. The message to global car giants was unmistakable: if you want access to the lucrative US market, you'll have to invest here. For European luxury brands like Porsche, these tariffs posed a direct threat to their long-standing business models, which relied on exporting high-end vehicles to American buyers, who craved prestige and performance. The options were stark: either absorb massive new costs and see profits shrink, pass those costs on to consumers and risk losing market share, or make the enormous investment required to build new factories in the US. For many automakers, the idea of investing billions in US factories was daunting, but the alternative, losing access to the world's largest car market, was even more unthinkable. At the same time, the federal EV tax credit ended, making imported electric vehicles even pricier for American consumers. Suddenly, the cost of going green was out of reach for many buyers. The double blow of tariffs and lost incentives hit foreign manufacturers hard, especially as the U.S. market remained a key profit center. Sales plummeted, and uncertainty gripped the industry. The global auto industry, long reliant on complex supply chains and free trade, was suddenly forced to rethink its strategies. Companies scrambled to adapt, reevaluating supply routes and production plans. The U.S. bet that its market was too lucrative to ignore, expecting automakers to localize production and create American jobs. The stakes had never been higher. But would these companies comply, or would they chart their own course and risk losing their American customers? The world watched as the industry reached a crossroads. The new trade barriers sent shockwaves through boardrooms worldwide, sparking heated debates and urgent strategy sessions at the highest levels. For Porsche, the stakes were especially high. The brand's identity, reputation, and future profits all hung in the balance. The company faced a defining choice: adapt to the new reality, invest in America, or hold firm to its traditions and risk being shut out. The world watched to see what Porsche would do next, as the future of the global auto industry hung in the balance. In the late 20th century, as U.S. tariffs on imported cars tightened their grip, the global auto industry braced for change. Many automakers scrambled to set up American factories, hoping to sidestep the new costs. With its growing popularity in the States, many expected Porsche to follow suit and consider manufacturing on American soil. But behind closed doors, Porsche's leadership weighed their options and ultimately delivered a firm, calculated no. The decision wasn't made lightly. It was the result of intense debate and careful analysis at the highest levels of the company. The math was simple, yet the implications were profound. Porsche's U.S. sales, while impressive for a luxury mark, simply weren't high enough to justify the enormous investment required for a new American factory. The risk of overextending the brand was too great. Even the idea of sharing a plant with Volkswagen or Audi was quickly dismissed. Porsche's unique engineering standards and meticulous attention to detail demanded a level of specialized production that couldn't be replicated in a shared facility. For Porsche, the brand's identity was inseparable from its German roots. The company's reputation was built on generations of German craftsmanship, precision, and innovation. To compromise that heritage, even for tariff relief, was unthinkable. Instead, Porsche made a bold choice: absorb the financial hit and double down on its loyal customer base. The company believed that true Porsche enthusiasts would continue to pay a premium for authenticity, exclusivity, and the promise of genuine German engineering. This defiant stance set Porsche apart from its competitors, many of whom compromised or adapted to the new rules. Porsche became a case study in resisting protectionist pressure and standing firm on core values. The company chose to protect its heritage and exclusivity, even at significant cost. For Porsche, every car was more than a product. It was a statement of identity. Porsche's gamble was clear: that its customers would value authenticity over price, and that the brand's mystique would endure, even as costs rose. The world's eyes were on Porsche as it stood its ground, refusing to bend to economic pressure or industry trends. Would this bold move pay off? Or would the costs prove too great? The stakes were high, and the outcome uncertain. The answer would shape not just Porsche's future, but also its legacy in the automotive world. In the end, Porsche was all in on its German roots, betting everything on the enduring power of its heritage. Porsche's refusal to localize production came at a steep price. In early 2025, its operating profit margin plunged from 14.2% to 8.6%. The company slashed its annual profit forecast, bracing for a turbulent year. U.S. tariffs alone cost Porsche over $100 million in just 2 months, a direct hit to its bottom line. Investors took notice as Porsche's financial outlook dimmed. Meanwhile, China, another crucial market, saw Porsche's sales collapse by 42% as buyers flocked to domestic EV brands. The combination of U.S. tariffs and a Chinese slowdown created a perfect financial storm. Porsche's once-envied profitability was under siege from all sides. The company faced tough questions about its strategy and resilience. Would its commitment to German production prove sustainable? The financial pain was real, and the pressure was mounting. Porsche was in uncharted territory. Mounting financial pressures forced Porsche to rethink its electric ambitions. The company scrapped plans for a flagship electric SUV, taking a $1.8 billion loss on the project. Investors were rattled as Porsche's share price plunged. Instead of expanding its EV lineup, Porsche pivoted back to its profitable gasoline and hybrid models. The shift was pragmatic. Demand for traditional models like the 911 and Cayenne remained strong. The EV transition, once seen as a sprint, was now a marathon. Porsche's new strategy balanced present profits with a cautious approach to electrification. For American buyers, Porsche's tariff strategy means higher prices and fewer choices. Many 2026 models already cost more, and further hikes are likely if tariffs persist. Some buyers may be priced out or forced to settle for lower-spec models. The canceled electric SUV leaves fewer options for those seeking a high-performance EV. The tariffs act as a luxury tax, narrowing the pool of potential Porsche owners. The dream of owning a new Porsche in America is becoming more exclusive and expensive. Within Volkswagen Group, Porsche and Audi took opposite paths. While Porsche refused US production, Audi embraced it, planning to build cars in America to sidestep tariffs. Audi's larger scale and broader market made local manufacturing viable. For Porsche, low volume and a brand built on German heritage made US factories unfeasible. The split highlights different strategies. Audi bets on adaptation, Porsche on exclusivity. There's no one-size-fits-all answer to the tariff challenge. Each brand is gambling on what it does best. Porsche's struggles mirror a global trend. Automakers are scaling back electrification plans amid weak demand and economic headwinds. Brands like Bentley, Honda, and Stellantis have reversed or delayed EV projects. Even Ford is shifting focus to smaller, more affordable electric models. High interest rates and unreliable charging infrastructure are slowing EV adoption. Improved gasoline and hybrid engines remain attractive to many buyers. The industry is learning that technological revolutions rarely happen overnight. The road to electrification is proving longer and bumpier than expected. Porsche's refusal to bow to tariffs is a high-stakes bet on brand strength and heritage. The company faces persistent financial headwinds and a fragmented global market. For American buyers, the result is higher prices and fewer choices. The era of seamless globalization is fading, replaced by regional barriers and protectionism. Porsche's story is a lesson in the clash between identity, economics, and politics. Whether its gamble pays off depends on customer loyalty and the company's ability to adapt. The iconic German automaker now faces one of the most challenging chapters in its history.